think all roads lead to inflation.
All roads lead to inflation. That's what Paul Tudor Jones is saying about our economic future. And if he's right, we might be closer to the financial tipping point than most people realize. This isn't just a blip on the radar. Jones believes that with the government's current spending and borrowing, inflation isn't just possible, it's inevitable. The problem? Inflation doesn't just make things more expensive, it eats away at our savings, reduces our purchasing power, and makes it harder to achieve financial security. If prices keep rising, the dollars in our pockets, in our paychecks, and even in our savings account simply won't stretch as far as they do now. But what does that mean for us right here, right now? In the next few minutes, I'll unpack why Jones is convinced that more inflation is coming, what it means for our finances, and the steps you can take to protect yourself before it's too late. But first, let's look at this interview clip of his.
And I want to try to frame in layman's terms. Let's assume that I'm making $100,000 a year. You've lent me, because we're such great friends, $700,000. That's what you've lent me. And I come to you and say, okay, Andrew, I'm going to pay all that back to you in 30 years. But between now and when I ultimately pay you back, I want to borrow $40,000 every year for the next 30 years. And then at the end of 30 years, I'm going to pay the whole thing back. Would you lend me that money?
Unlikely.
You son of a bitch.
Right.
I thought you were my friend.
Well, this is the problem that we have.
Okay, so that's actually the proposition that the U.S. government makes to every bondholder today. That's the exact same proposition. So think about this. We owe $35 trillion. Our tax take is $5 trillion. So we owe 7 times what our tax take will be this year. Our revenues will be this year. And our deficit is $2 trillion, and it's $2 trillion right now as far as the eye can see. That is literally the proposition that the U.S. government is making to someone who buys a 30-year.
So let's talk about that example Jones gave, where he compares the U.S. government's debt to a friend loaning him way more than he could ever realistically pay back. Think about it. Your buddy who makes $100,000 a year asks to borrow $700,000 from you, and then keeps asking for $40,000 more every year. You'd probably say, are you sure you can handle that? Because let's face it, it's not sustainable. And that's exactly the issue he sees with the U.S. debt situation right now. Here's what Jones is getting at. The U.S. government's spending habits have gotten, well, a little out of control. Right now, the country's debt is way higher than the revenue it brings in from taxes. In fact, our national debt is so massive that it's creeping up on 130% of our GDP. That's basically more than the total economic output of the entire country for a year. Jones thinks this debt to GDP ratio is a red flag because as debt grows faster than income, it starts to strain the economy. But why should we care? Well, high debt means more taxes, cuts to public services, and even a hit to our savings. If the government has to pay off debt by taxing more, that could mean less money in your pocket. And if they make cuts, things like Social Security or public health care may take a hit. Plus, here's another kicker. When the government owes a lot, it also has to offer higher interest rates to get people to lend it money, which means more national debt in the future. It's a cycle that just keeps going until something breaks. So this isn't just a big government problem, it's a personal one. The higher the debt, the more it will impact the services you and me rely on and the money we take home. And that's why Jones is sounding the alarm. Because the deeper this debt hole gets, the harder it will be to dig out of.
Yeah, we're in an economic kayfabe right now. And it's not just the United States, we're in it in the UK, in France, Greece, Italy, Japan being the biggest of all. It's this economic kayfabe, and the question is after this election, will we have a Minsky moment here in the United States in U.S. debt markets? Will we have a Minsky moment where all of a sudden there's a point of recognition that what's going to happen or what they're talking about is actually fiscally impossible, financially impossible?
Jones's kayfabe analogy really says it all. Here's an example of this. Imagine you're watching a wrestling match where everyone, the audience and the wrestlers alike, agrees to pretend it's real, even though we know it's all staged. Jones sees the US economy in much the same way. Right now, our economic system is propped up on massive debt, and everyone's just kind of hoping the show keeps going without unraveling. But here's the problem. When debt piles up faster than income, the economy starts running on borrowed time. And that's the debt to GDP ratio. Basically, how much we owe compared to what we produce as a country keeps climbing. It puts the economy in a more fragile position. Think about it. If your own debt-to-income ratio gets too high, you'd have a tough time getting new loans, or might even face higher interest rates. The government is in a similar situation, but on a much larger, much scarier scale. Right now, the US debt-to-GDP ratio is close to 123%, which means our national debt is more than our entire economy's output in a year. Historically, experts warn that once a country's debt passes 77% of GDP, it starts to weigh on economic growth. We're already way past that threshold. If we hit 200%, like Jones predicts, we're talking about levels not seen outside of severe crises. Think countries like Greece during the Eurozone debt crisis. High debt to GDP ratio makes it more expensive for the government to borrow, which means more money spent on interest payments and less for services that people rely on. So what does Jones think? He sees us on a trajectory that could lead to a debt to GDP ratio of 200%. For context, we're currently hovering around 130%, which is already historically high. If we double that, the risks multiply. We could face major issues like cuts to public services, slower economic growth, and worst of all, the potential for a debt crisis where the government struggles to pay its bills, and ultimately, a recession.
Can I just say this?
Yep.
You have to let the tax cuts expire.
You have to.
You have to let those expire. That's $390 billion. We're going to have, again, we're gonna be broke really quickly unless we get serious about dealing with our spending issues, and unless we can either. I don't know if we'll be able to cut spending that much. 60% of our spending are transfer payments.
Now, Jones has a pretty blunt take on this. He says we simply can't keep promising tax cuts and spending increases without serious consequences. According to him, if we want to get our financial house in order, we have to make some tough choices. Letting tax cuts expire, cutting back on spending, and maybe even raising payroll taxes. But the real kicker is that even these measures might only scratch the surface. Our debt problem has grown so massive that it's not just a matter of minor adjustments. It would require serious across-the-board reforms. And while these kinds of reforms can be politically unpopular, Jones believes that they're essential if we're going to avoid major fallout. For everyday people, this could mean fewer government-funded programs, higher taxes, and potentially more inflation. Because when the government's paying more interest on its debt, that cost can often trickle down to taxpayers. So it's not just about high-level politics, it's something that could impact our daily lives, from the cost of groceries to what we pay for healthcare.
I think all roads lead to inflation. We're going to end up, but
does all roads lead to inflation, therefore gold is a good investment? Is Bitcoin a good investment to you?
I'm long gold, I'm long Bitcoin. I think commodities are so ridiculously underowned, so I'm long commodities. I think most young people find their inflation hedges via the NASDAQ. That's also been great. It's probably some combination. I probably have some basket of gold, Bitcoin, commodities, and NASDAQ, something like that, and I would own zero fixed income. If I had my cash, it'd be very short term. The playbook to get out of this, you see it in Japan right now. They have 2% inflation, 30 basis points overnight. They don't want to raise rates. The playbook to get out of this is that you inflate your way out, and you have a small tax on the consumer, and you run interest rates and nominal growth rate, interest rates below inflation and nominal growth above inflation, and that's how you reduce your debt to GDP. So you're going to have the Fed they should be easy. They should be
easy. You want them to cut.
So just real quickly, every 100 basis points, given where our debt to GDP right now, every 100 basis points is worth about $90 billion a year to the deficit. $90 billion. So yes, if we're trying to stabilize debt to GDP, we want to run the most dovish monetary policy that we can.
When Paul Tudor Jones says all roads lead to inflation, he's not just making a prediction, he's actually putting his money on it. And that's why he's investing in assets like gold and Bitcoin. But what makes these investments his top picks in an inflationary environment? Let's start with gold. For centuries, gold has been known as this safe haven asset. During times of economic uncertainty or high inflation, gold tends to hold its value better than cash. That's because gold isn't tied to any one government's currency. It's universally valued, and historically, when people get nervous about the economy, they turn to gold. So Jones isn't just buying gold on a whim, it's a strategy that has stood the test of time. Now, Bitcoin is a different story. Bitcoin is relatively new, and it's a lot more volatile than gold, but it's often described as digital gold. Why? Like gold, Bitcoin has a limited supply, meaning there's a cap on how much can ever exist. In theory, this scarcity makes Bitcoin resistant to inflation in a way that traditional currencies aren't. For Jones, Bitcoin offers a hedge against the potential devaluation of the dollar, a currency that could lose value if inflation spikes. And it's not just gold and Bitcoin. Jones is also betting on commodities like oil, natural gas, and metals. Commodities are physical goods, which means their value usually rises when inflation is high. Think of it this way. When the cost of living goes up, so does the cost of producing and transporting goods, and that tends to drive commodity prices up too. So, by investing in commodities, Jones is essentially betting that the prices of these essential resources will keep rising. But why not traditional investments like bonds or fixed income? Well, here's the thing. Bonds don't perform well in inflationary environments because the interest they pay doesn't keep up with rising prices. In fact, holding long-term bonds when inflation is high can mean losing money in real terms. That's why Jones is steering clear of fixed income investments and focusing on assets that have the potential to grow in value even as inflation eats away at purchasing power. Alright, so Jones's strategies sound interesting, but what does this really mean for you? Most of us don't have billions to invest into gold or a huge Bitcoin portfolio, but there are some practical takeaways we can apply here. One of the biggest lessons is the importance of inflation-resistant investments. Inflation essentially eats away at the purchasing power of cash. So investments that either grow with inflation or aren't affected by it as much, like certain stocks, real estate, or even inflation-protected bonds, can help safeguard your wealth. Treasury inflation-protected securities, or TIPS, are one option specifically designed to adjust with inflation. If you've never heard of them, they're basically government bonds that increase in value as inflation rises. So, for small investors, this is a reminder to look at assets that can handle this kind of environment. Besides TIPS, there are dividend-paying stocks, certain types of real estate, and even commodities that can offer some inflation protection. Stocks tied to essential sectors, like utilities or consumer staples, can sometimes perform well even when inflation rises because people will always need those goods or services. Diversification is also key. Rather than betting everything on one asset, spreading investments across different types can help you weather different economic conditions. If one investment type, like bonds, underperforms during inflation, others, like commodities or certain stocks, might balance out the impact. Want to know Michael Burry's warning about what comes next? Hyperinflation, debt crisis, and a crash. Click the video on the screen to find out.